Hey, Greg.
Eric, good to see you, man.
What's happening? We're recording. So we've been chatting for a while here before we get started, which we tend to do, and said, we should just start recording and get this on the record. So what's happening personally in your life? What's going on?
Well, we'll talk personal stuff first. We got to make our disclaimer. In fact, you know what? Let's get this disclaimer out of the way, and then I'll do the personal. So reminder, information broadcast today is not for, it's no type of investment advice. It's for educational, illustrative purposes only. We're not giving you advice. Make sure you do your own homework. The options market does involve risks, not suitable for all investors. All rights, risks, and obligations need to be understood before placing any type of trade. So,
and the reason he says that is because I'm going to talk about a live trade that I just placed just before we started the show. I'm going to share it with you at the end on Tesla.
And I still have to disclose, I'm a registered advisor. I don't manage a lot of money right now. I don't like to. I'd like to trade my own money, but I am registered, and so keeping my regulator happy.
Okay.
So personal life. My kids went back to school this week. That's good.
How's the garden?
The garden's fantastic. Rolling food out more than I can keep up with. We bottled, my wife and I canned, we love canning, by the way, love gardening. We canned 58 pints of green beans this week.
Can anybody eat that many green beans?
I don't know if I'm going to eat that many green beans, but
that's a lot of, you're going to give them away?
I'll give them away. I've got some to share. So,
okay.
So yeah, we've been gardening a lot. I've been watching, I've introduced my teenage kids, my now teenagers who just started 8th grade this week to Lost a week or so ago. I know, and they love it. We're just in the first season. Actually, I think we finished season 1. We've been binging it a little bit. Starting into season 2. I keep not wanting to tell them, oh, you're gonna hate the last episode. But anyway,
oh man, I was all in on Lost. I was listening to multiple podcasts and going to blogs, and oh man, I got all the DVDs or the Blu-rays, I guess. But man, I was all in on that show. It was really game changing. It really changed a lot of things, I think, as far as TV. I think.
So, who is your favorite character on Lost?
Locke.
You like Locke? So me, it's close between either Locke or Hurley.
Oh, Hurley's awesome too.
I like Hurley too.
Yeah. I don't know. All the characters are pretty good. Of course, there's Kate, and then I don't know, all of them. I just it was a really good show. Jack, he was supposed to die in the first episode. They changed so much of it because it was so successful. I think it was supposed to be 3 seasons, and they turned it into 6 or 8 because they already knew the end. They just kind of had to expand, and So speaking of that, I'm guessing you didn't start watching the new House of Dragons yet, have you?
Not yet.
It's pretty good. It fits right in. It looks like it didn't miss a beat as far as Game of Thrones go. It just the characters, the cinematography, the script, the special effects. It fits right in, and I think overall people are pretty happy about it. It is a little bit on the gory and the bloody side. My wife had to stop halfway through the first episode and take a break, so we had to come back and watch the next day. Also, for me personally, you might notice my nose is a little. This morning I did my forced yoga, involuntary yoga class, which is also known as jiujitsu. So I spent a lot of time in a headlock this morning, so that's why my nose is a little rosy.
Not a line you hear often. I spent a lot of time in a headlock this morning.
Oh, I love jiujitsu. It's awesome. It's actually really good therapy. I mean, it's great exercise and mentally, and it's all around a great sport. I love it.
Well, big week this week for the markets. We've got Jackson Hole going on right now.
What's Jackson Hole? Isn't that it's a place in Wyoming? What's going on there?
If I look out my front window, I can see the Tetons. In fact, there they are right there. I just looked out my front window. Big week. Federal Reserve there. Jay Powell, Esther George, a lot of members of the Federal Reserve there this week. Very publicized event. It's almost, I think, a dog and pony show at this point. They may have some Chatham House rule discussions there. I'm sure they probably do. But the ones we get to see are pre-written, pre-scripted. They know what they're going to say. Very, very little impromptu, off the cuff type of comments. But it will be interesting to see, because they've been in a quiet period for a while. Now that they're talking again, they've got this meeting started. the Federal Reserve board members, the voting members, have been very vocal the last couple of weeks about the market thinks we're done raising rates, and we're not. We're still battling inflation. We got a long ways to go. So it'll be interesting to see comments from Powell this week.
You're absolutely right. Listen to a lot of the noise that you see. I say noise, I meant news, but it is noise because it's all sort of bouncing off the walls. And what do you think? And what do you think? You and I have been fortunate to actually sit down and talk with voting members of the Federal Reserve in an informal way. And I took away, especially from what we heard from Chris Waller, and what he said was not Chatham House rules. It was on the record that the Fed is committed to getting inflation under control. And the only tool that two tools that it has is one is quantitative easing, and that is our quantitative tightening, I should say. So that's reversing the quantitative easing of buying assets. And the other is to control the Fed funds rate. What's your over under on 75 basis points? So this is what people are sort of looking at. Do you have would you put a probability or a number on it, or any thoughts on what you think the next number would? This is what a lot of people are talking about. I'd like to hear your thoughts.
I still think it's a pretty high likelihood that we're going to see a 75 basis point increase. If I had to put a number on it, I'm 75, 80%. And the reason why I say that is we still are running inflation at 8%, which is way, way above the Fed's target. And the only reason it's come down from 9% the month before was a drop in oil prices, and oil prices have stopped dropping. They haven't gone back up, but they've stopped dropping. So I don't expect that's going to last. Oil seems to have found a bottom here at about $90 to $93 a barrel. So the other problem is we're starting to see food inflation start to creep up. And so I don't expect them to back off. The other thing that's happened in the last week is we've had another bazooka of Fed stimulus or government stimulus, right? I mean, I know it was not directly to everyone, but we just canceled between $10,000 and $20,000 of student loan debt to borrowers. And although some people don't realize that's a bazooka of stimulus, that's a lot of money that just got canceled, that now retail buyers have free cash. They just freed up all that money. What are they going to do with it?
YOLO Dogecoin.
Yeah. Maybe we should all go buy Dogecoin with it.
AMC, Bed Bath and Beyond. Golly. Well, you're correct. I think sometimes I take a look back, and I literally did ride a short bus to high school. And that's not because I got bused to a different town because it was a long story, but I'm not as smart as everybody else. I got to sit back and look at some things. I mean, people are blaming the Fed for the inflation, and I agree that the Fed can cause inflation. But if we look at the low interest rate policy that we had forever, inflation didn't really change until we kicked $5 trillion of stimulus into the economy. And now we're about to kick in another roughly $1 trillion. Now, it's not as bad as it sounds. I mean, my first reaction was, what? But Ben Hunt put a piece out that mentioned that it's people are deferring their loans right now anyway, so it doesn't really change anything. Although, there is a wealth effect sort of thing when your house value goes up, you tend to want to spend more money, whether you have more money or not. Like, you feel richer. I think the same happens when your debt goes down. So if you had 40,000 in debt and now you have 30,000 in debt, you think, oh, I can go spend 10 grand. I don't know. I think, I think there's moral hazard. There's some other issues there right now. I mean, from an economic standpoint, this is important for the discussion here, not really to share our personal opinion about whether we think this is the right thing from my standpoint. You can contact your congressman. Well, we're trying to talk about it from an economic standpoint. And I think you and I didn't talk about this ahead of time, but I think we're aligned in that our concern would be that this is the opposite effect of what we're trying to get under control with inflation. I mean, you see the same thing?
I do. I think it's going to push prices up on almost everything again. We just shot stimulus into the economy, and it doesn't need it yet. We haven't even really started tightening yet. I know there's a lot of discussion about, oh, well, the Fed's raised rates, and we're starting to see slowdown in different things. Well, some of the slowdown doesn't have to do with the liquidity of the markets at all, and there's still plenty of liquidity out there. So you made a good point. I want to kind of follow up on it. This inflation thing didn't just start because of the Federal Reserve. Maybe it did start because of the Federal Reserve, but it didn't just start in the last 6 months. This has been building for a long time. We've had zero interest rate policy at the Fed for a decade or longer, since 2008, 2009. We've been in zero interest rate policy basically with this economy. And every time the market has had a hiccup, the Fed, blasts the market with liquidity again. And this last time with COVID, they just blew so much liquidity in the market that, yeah, it's driving inflation. And if you think it's going to be gone in 6 months because the Fed started talking tough, I think, we're fooling ourselves thinking this is going to be gone. I'd say even before the middle of next year at the earliest. So I think this inflation problem is here for a while. Maybe I'm wrong. I hope I'm wrong. What the Biden administration just did by canceling student loan debt is just throwing more fuel on the inflation fire.
Yeah, I was just trying to pull up a chart on Fred to look at the Fed funds rate and that versus inflation. And I'm not as fast as I could be, but I did have two other charts that you sort of touched on. One, and that is, this is the Fed, one that everybody likes to talk about is, and that's the Fed balance sheet. So when they were adding to this is quantitative easing. The Fed's going out and buying assets to help create liquidity by pumping money into the system. And we're starting to see it roll over. So that's a 10-year chart. So I guess here's a 1-year chart. So from a 1-year standpoint, we're seeing, depending on how you look at the scale, we're no longer at our peak of $9 trillion on the total assets. We're starting to roll over. So it is heading in the right direction. There's a concern about what will happen when we start pulling liquidity from the market, though. Right, Greg? That's what we were talking about ahead of time.
There is. And in fact, there's another way to look at that too. And that is to look at the overnight repo rate, the overnight repo market. Now, I know this is a little bit wonky for a lot of you who don't follow the banking system and don't understand what the Federal Reserve does, but a simple way to talk about this chart right here that you can see just exploded in 2001 to the upside. It was non-existent balances. We had a little bit of it, as you can see, between about 14 and 18, but not very much. Again, that's in billions. So we're talking, this is a daily measurement of what banks are doing with the Federal Reserve. And essentially what's going on, I'll try to do it in layman's terms. A bank has too much cash. They're controlled now by Dodd-Frank on how much assets they can have on their books. And so what they are required to do on a daily basis is try to balance their cash. And so what they do is they go swap it overnight with a cash equivalent security with the Federal Reserve. Now, what's a cash equivalent security? It's a bond. It's a short-term treasury bill or a T-bill that the Federal Reserve has on their balance sheet. They just swap them with cash with the bank overnight. They swap it back. Now, I know a lot of you are like, what does that even do?
Yeah, should people listening to us right now be freaked out about this?
I don't think so necessarily.
I agree. This isn't something to freak out about. This is
a measurement of how much extra cash is in the system.
Right.
Because the banks can't hold it on their books, so they have to have somewhere to go with it.
Right.
There's no more bonds for them to buy. They can't go put it in risky assets because of Dodd-Frank. And by the way, Dodd-Frank is a piece of legislation. If you don't know what that is, it's rules that regulate how banks can act. We had to slap the bank's hands back in 2008 because of how they acted in financial crisis in the housing market. And so that Dodd-Frank is a result of that crisis. It's legislation put in place that controls how banks can move their money around. Now,
so this isn't a problem. This is just saying that there's roughly an extra 2.2 trillion in cash that's floating around in banks that banks don't need. Isn't that what it is?
That's exactly what it is. And so another way to look at that is the Federal Reserve can pull $2.2 trillion out of the economy right now.
Off of the balance sheet.
Off the balance sheet, and really not impact the liquidity that's in the market right now, that's in the system. Now, we should see, as they do this, we should see the Federal Reserve, or that number, that overnight repo rate number, start to decline the same way we start to see the balance sheet decline. And it shouldn't impact the markets much. The problem with the market right now is you hear the talking heads all the time. It's like, oh, well, they've already raised rates. It's already all priced into the market. I disagree with that. There's still huge amounts of liquidity chasing investments right now. Looking for
the point here is that we haven't really seen the adverse impact of quantitative tightening yet, and it can
not at all.
Quite a bit. No, and that's the point, is keeping an eye on this number, and even if it does drop down to something that's normal, which in the past has been just, I mean, not even just orders of magnitude lower, and we're talking trillions here, so we're talking millions and billions down here. It can drop down much lower, and even then it may not have an impact, but probably not going to have a big impact for quite a while, at least from our perspective. And we're sharing what we've learned, talking from the likes of can we say names? I don't know if we can say names, but we already mentioned some. But talking to people at the Federal Reserve and other people who would definitely understand this market, that's what they're looking at anyway. So
I think we're okay right now. I don't think there's a lack of liquidity in the market. I don't expect the markets to seize up anytime soon, the economy to seize up anytime soon. My biggest concern still is on the inflation side. My biggest concern is there is still too much liquidity in the market. We just pumped more liquidity into the market by forgiving all these student loans. And I think inflation we may see a higher read at the next one. Maybe not, because gas prices have been such a big part of it, but I don't expect we're going to see much lower of a read. And I think that's what we're going to hear from Jackson Hole this week.
One of the things that happens is, so the Fed is changing policy. They have different things they can do. We just talked about a couple, and then we have Congress and of course the executive branch that are doing fiscal things. And there's lag effects. Some of these things, they happen. Some things happen really quickly, and they play out quickly. Others can take months or maybe 6 months or a year to play out. This is one of the things that makes an economist's jobs difficult, is because we reach tipping points, and it's difficult when you've got different cross currents of things working. But I think we're both in agreement. I don't agree with you that we're going to immediately see an impact on the student loan in terms of inflation. Although I will say it's going to make the job harder to lower it, and it may play out, but I don't think it's going to be immediately. I think it's yet to be seen, right? Because I know some people, some millennials who have some college debt, and be interesting to see how it affects them, and certainly be talking about that with them individually, sort of to get my channel checks up. So that was, we talked Jackson Hole, just to loop back on Jackson Hole. I think, I expect the Fed to stay at 75 basis point. I gotta be honest with you. I hear people saying the market doesn't believe the Fed's going to raise rates. I don't know where people are looking for that. I mean, maybe looking at the S&P 500 going up, but I don't think that's the indicator. I think if you look at like the CME Fed Watch tool, it's pretty clear that the market is looking for rate increases. I mean, how many and when, I don't know what they're expecting, but clearly the market is expecting an increase, and more than a 75 basis point if you go out far enough in time. So I'm not on the same page that the market's not pricing it in.
Well, we will definitely get to be overloaded with commentary the next several days of where the Fed is thinking this is going. And I think with the run the markets have had the last couple months since the bottom in June, we've given a little bit of it back to start this week. I know we bounced today, we bounced a little bit yesterday, but we had a rough go of it the first part of the week. I expect that the short-term top may be in, and we may chop around here. I think the biggest risk is to the downside right now if we get some pretty aggressive commentary out of Powell on raising rates. What else is going on?
Well, I was, we did have a split with Tesla.
Oh yeah,
that was effective today. Just want to talk a little bit about splits in general. From an option, if you're an options trader, what you want to do is always look for the Options Clearing Corporation. They are the place where you're going to find out exactly what happens in terms of if you own options and there's some sort of thing like maybe a split or an acquisition or reverse split or some special dividend to see how it impacts options. I always suggest people find the OCC, so it's the Options Clearing Corporation that announce what happened. And it's pretty straightforward here. So if you had one contract, you're going to end up with three that will be divided. So if you had a 300 strike contract, you'll end up with three 100 strike contracts. So on the left here, we have the original pre-split strikes. And then on the right, we have the split strikes. So just as a reminder, if you look at some of these strikes, they're kind of weird numbers. And my experience is traders probably want to avoid anything that's not a round number. If you're already in it, if you ended up with a 93 or 33 or whatever the number is, you can see all the strikes here. You can end up with some weird numbers. They tend to be not traded as well. Liquidity dries up, and what that means is you'll tend to overpay for the bid-ask spread. And some people talk about how Tesla tends to go up, or around stock splits. People do, stocks tend to go up. That's not the case. If we go back to the last split, so this was the split that happened, the 5-for-1 split. So here's when the split was announced. That's when the split occurred. It looks like there was some reaction right away. Looking at when the split was announced this time, that was back in 2020. This is 2022. This is recently, is that the split was tweeted that we may split. And I think there definitely wasn't there's other things that were going on, but the split was officially announced here. It's going to be effective. So that's when it's actually not effective until the end of the week. So if you buy now, you will get the split shares. I did this a few days ago, but anyways, I don't think we saw a necessary big rise up. Still, I think there's an opportunity here. A trade that I've been doing, or I did for quite a while on Tesla, when it was in the $700 or $800 range, is I like covered calls. So in a covered call, we talked a little bit about covered calls in the previous example. I'm okay normally getting a sign. So I'll sell a call at a strike that works for me. And I did execute a trade this morning, and this is just for information purposes only. And this is not trading advice. I'm certainly not advocating that anybody do this. But I'm telling you what I'm doing, just to show you this is what we teach with OptionsANIMal and what people do on Trader Oasis. So here's the current chart of Tesla. We got a little bit of a pullback today. The stock's down a little bit, which is it's interesting, but it is what it is. The strategy that I did, which is one of my favorites, is a in the money exploding covered call. Yeah, a lot of moving positions, a lot of moving pieces there. So what I did was I bought the stock 100 shares at $293.30, and I sold a 280 call. So that's a 280 call in the money, and I collected $22 on that. And I also bought a call. So if this is a risk profile, these tools are very helpful for people to visualize how they make money. You've got the stock price on the x-axis, and the y-axis is your profit and loss. So if I just did that covered call, so an in the money covered call, it's not a bad return. You're looking at making $888.50 if the stock expires above 280. The break even is actually going to be much lower. The break even's around 271. Now, there's some rumors, or not even a rumor. Elon Musk tweeted today that there's an announcement today after the close with T-Mobile. I don't know what it's going to be. There's long time rumors about Tesla coming out with a new phone. I don't know if that's the case, or maybe there's something to do with Starlink. Who knows? So what I did was I placed a long call with this. I used some of the premium that I collected by selling the short call at 280. I bought a 310 long call. And so what I have effectively is an explosive trade. The reason people don't like covered calls is, as we talked about this woman before, is that the stock exploded, and some people describe that as a risk, that if the stock explodes to the upside, well, you make money if the stock goes to the upside. One of the ways that I like to sort of offset that, it's not a risk, it's a missed opportunity. So FOMO, fear of missing out, isn't risk. But this is the strategy. We've got a lot of different things. There's a lot of moving parts going on this trade at one time. So this is definitely not for novices. But the thing I like about this trade is my break even after buying that call, my break even is going to be at 278.60. I've got about a 66% chance of the stock staying above it. If we go look at the chart, it is above what has been historical support. If the stock starts trending down, what I'm going to do is I'll end up closing that long call, which will move my break even lower. I don't have an explosive upside potential, but right now I've got a high probability trade of making a small profit. So this is a dynamic trade. If I can get out, I'll show you some of the math here on the Excel spreadsheet. So I like to calculate the math. My target on this is going to be to make 20% return on risk. So if I can get an explosive move to the upside, but if I don't make that and I can close that call, we're looking at making about 3% return on risk in 32 days. That's 37% annualized return. Now, this isn't gangbusters. This isn't like YOLO, gonna double or triple your portfolio. This isn't like winning the casino, winning a lottery, or betting on a horse. You're actually being more like the casino in this sort of style of trading. It's small, consistent income that's actually relatively low risk. If the stock does start moving down, what I'll end up doing is putting this into a collar trade and protecting myself to the downside. But this is a sort of strategy that I think if you understand how to manage it, you should be able to generate pretty consistently about 20% return on the capital that you're using in the trade. So any thoughts on that, Greg? I don't know. You're the one that sort of taught me how to do this. You were the first one to ever teach me the exploding covered call, and it's one I love.
Well, yeah, my thoughts on it are 20% a year is what one of my heroes in the investing world has hit year in, year out for his entire career. That's Mr. Buffett. So I know people want to play the stock market like it's a casino. Please stop. Please don't. If you are, yes, you can make a lot of money, and then you can go from here's a sad story that was shared on Twitter, and I read way too many of them over the last several years. Guy trading the market has made like $1.5 million trading options in 2021, doing YOLO trades, right? Chasing AMC, chasing Tesla was at the time a little bit of a YOLO trade. Now it's still fundamentally a good company, but there was a lot of people that were trading the market as the casino, and they did really well, and they made all this money. And so when you make a lot of money in a cash account, you're going to have to pay taxes the next year. Well, the problem that happened from January to June of this year is this person who's sharing their story said, I made all this money. I just lost it all in the first 6 months of this year. And I still owe $1.5 million in taxes. What do I do? And that's a reality that when you're trading the market as a casino, you can make a lot and then you can lose it all really quickly with options. So the way we trade is different. It's boring for a lot of people, but it's consistent. And yeah, that's the way I trade as well. So love it.
I thought you would. You know, these anecdotal stories happen. I don't think you know about this one, but one of our instructors is in a trading club with some of his fly fishing buddies, and one of these people is somebody that's personally very wealthy. Was trading naked puts on MicroStrategy. Have you heard about this?
Oh no, I've not heard about this.
No, yeah. This person and our fellow instructor, you know who I'm talking about, tried to sit down with him and say, hey, listen, he didn't know him well. They were in the same they had a trading club. They'd get together once a month, and tried to explain to him that, doing naked puts and I'm making money. So this is true story. In the past week, he sent me a link of a house explodes in the town that this guy lives in. The only thing that's left is a chimney. And he said, I don't know if the two are related, but he definitely was doing a lot of naked puts on MicroStrategy. By the way, MicroStrategy had a major crash. And if you were in naked puts, there might have been other stuff going on, and I don't know the details of the story, but we hear these tragic stories time and time again. And the other point that I wanted to mention about the casino thing, and it's in there, is if you make money in the casino, the tendency is to keep playing and to double down, and you start scaling up your sizes. And there's people that are in this game, in this as a game. Then there are people in this as a business. And I think if you want to treat something like a business, whether whatever it is, I mean, it doesn't come by luck. And so by being rigorous and having trading plans and setting goals and having exit plans, that's how you're going to be consistently making money. But some of you folks want to gamble and play, and so and we do too. Greg and I both. You'll catch us at a craps table in a casino, and so but we're able to separate that and limit that. So I think there's room in your portfolio for YOLO trades. Going out and doing something crazy. I own Bitcoin. I own Dogecoin. I own AMC in my Robinhood account. Okay, I had to do it, and it's just a joke. It's about a quarter of what it was when I bought it, but I it's a little bit of money. It's not going to affect my standard of living. So I just wanted to throw that out there. Share some ideas with trades. If you want to learn more about it, we can help you guys, because that's what we do, is we teach this people other stuff. Reminder. Like, share, and comment. So if you like what you hear here, ask questions down below. We'll continue to build this channel and share. And anything to wrap it up, Greg?
Let's talk early next week. We'll talk about what's going on with Jackson Hole. So
okay, all right, and I'll update people on that trade, see how it's going.
All right,
we'll talk to you later.
Thanks, everybody.
See ya.